Hi, this is Pete Birchler of StockMarketAlchemy.com. Today is March 4th after the U.S. markets closed, and today's video update is going to be kind of something different than I typically do on these YouTube videos. Today's video is going to be very educational and practical to helping anybody in their trading have a method of capturing larger profits and being able to systematically adjust stop losses to allow themselves to have the market to continue to move in their favor, so that you can capitalize on the small percentage of trades you have where the market really moves in your favor. The 80-20 law basically says that about 80% of your profits is going to come from 20% or so of your trades, and I would say that is true, and you might even find that it's even a little bit less than 20% of your trades actually make up the huge bulk of your profits. And if that's the case, then how do you have a non-emotional, methodic way to move your stop losses so that you allow that market to really hit you a grand slam? And there are different ways to do that. And so I guess part of this video is to give you a very systematic way to do that, provide you some valuable trading education that's applicable, very, very easy to use and applicable really to almost any method you use. And then the other part of this video, I think, is to give people watching this, at least from my standpoint, a little bit of a view inside to some of what I do in my StockMarketAlchemy.com website with my integrative harmonic trading methodology. So that is the course that I really teach in trading. And this is going to give you not the techniques I use in that, but it will give you a little bit of insight into the type of patterns we trade, and you're going to see a lot of successful examples of those patterns here that I've either suggested on my website in the past or on the blog for people who are taking my course training, because part of the course training is a full year of mentoring and periodic blog updates just for people who are taking the course, so that you're getting real-time actionable information on the markets, and so that we can have an actual mentoring and conversation taking place where we're looking at the stocks you're interested in, analyzing them, and helping you get the most out of what you're seeing. So I hope to kind of accomplish both those things in this video, but primarily give you some really good information on how to trail stop losses in trades that you're in. And then depending on kind of the feedback on this, I could go into some more detail on kind of just using this these methods that I'm teaching you here as a trading system for entry signals, and then give you some more refined exits as well. And those are things we can get into if there's interest. But to start off here, what I'm going to show you how to do is basically give you a brief explanation of what we're doing and show you how to set this up on charts in freestockcharts.com. In my opinion, that's the most power pack free charting service that's really out there. So it's through Warden Brothers, which makes Telechart, TC2000 and those type of softwares, but they really have some great free stuff here on Free Stock Charts as well. And in my courses, I basically teach everything on how to do it with free tools, so you're not getting tied into softwares and other type of subscriptions. So you really become an expert trader and know how to use various forms of analysis to understand the markets, rather than being dependent on people selling you more and more tools and subscriptions and those type of things. So that being said, if you have an account at freestockcharts.com, then you'll be able to easily do this. If you don't, you can always go sign up for one very quickly. And then if you use another type of charting service or subscription service, pretty much any legitimate paid-for service out there will probably have these same capabilities that I'm showing you here. You'll just have to figure out how to do that in your charting service. So what I'm going to teach you is how to plot a moving average channel on your charts, and I'm going to show you how to use this to move the stop losses. So in freestockcharts.com, what we're going to do here, I'm just going to readjust the screen for a minute, is we're going to go to Add Indicator. Okay, and we're going to add a moving average. So you can either scroll down or you can just start typing in moving average. And let's just go to the general moving average tab here, and we'll click on that, and then it says add moving average to, and that means, do you want to apply the moving average to the price charts, or do you want to apply the moving average to one of the statistical studies down here, because you can apply moving averages to indicators as well. For this, we just want to add it to the price history. Okay, so we're going to select price history, and by default it's going to give you like a 50-period simple moving average, but we're going to edit that. Okay, so we're going to go in here and click on it, and then we're going to click edit. And then to plot the moving average channel, you can leave the plot style as a line. The plot color doesn't really matter, but what I'm going to show you here is we're going to use a red line for the bottom of this channel. For the bottom of the channel, and this is going to be really useful for trailing stops on long positions. So you're long the issue and you want the price to go up. We're going to use an 8-period moving average. And then the average type will be simple, but here's where it differs from a typical moving average. Is instead of using the moving average of the close or the last price here, which is common, we're going to use the moving average of the low for this. All right, and then everything else you just leave the same and hit OK. And then to create the upper end of the channel, we're going to go to Add Indicator, we're going to type in Moving Average, we're going to add another moving average, add it to Price History just like we did on the last one. On this one, we're going to go and we're going to edit it. I'm going to change the color to green because that's what I use for it. In this period, we're going to choose period 10. The reason I choose these periods, these periods are based off of some of Jake Bernstein's work. So if you have any familiarity with his work, these are the ones he's tested and used. I do find them to be very effective, so I would agree that this using these periods are very effective. Now the average type again will be simple, and this time we're going to apply it to the high. So we're going to click high and then hit OK. And this gives us a moving average channel, and if you look at the channel, you can see that the channel does not remain at equal width on the chart. So you're going to have, let's scroll in a little bit here, you're going to have the periods where the channel is very close together like it is here, and then you may have periods where it's very wide. And because we're taking averages of the high and the low, so we're taking of the entire range of the day as opposed to just one point, this channel is a dynamic channel. So it's not just some type of percent channel moving through time. This is a dynamic channel based off of actual, price highs and lows. And I really like that about this method, and you're going to see as I take you through these examples, how great this can work and how these moving average channels will really adapt to market action and be able to allow you to stay in a trade through some major consolidations and still follow that trade in the direction of your trend. Okay, so what we're going to do here is let me give you let me show you some drawings on this chart here. Just to kind of set the stage for some of the patterns that we're looking to trade. And that's not really what this is about, but I want you to kind of see that. In my course, if I gave you a simple description of what I teach in my course, I call it integrative harmonic trading, and the reason I call it integrative is because we're integrating several independently successful forms of analysis into one kind of super form of analysis. So we're taking technical analysis, so the study of price movement over time, so we're taking technical analysis and indicators. We're taking chart pattern analysis, so chart formations, and we're taking sentiment analysis, so the study of the underlying market mood, both in the broad market as a whole and also to some extent in individual stocks, and we're combining that into then an objective indicator-based entry and exit strategy that's can be basically used on any market in any time frame, and it's tuned to the size of the pattern. So in this case here, we're looking at a pattern of a stock that begins in 2009 and then completes in 2013. So this is a 3.5-year pattern or so that we're seeing develop. And so the indicators we're going to use for the trading methodology are going to be adapted to the duration of the pattern. For the actual stop movement strategy I'm going to show you here, I'm not going to give you any objective guidelines, but with going through these examples, you'll be able to figure out how to use it effectively on your own. So in this case, we have a pattern, and this would be a typical pattern that we look for to trade in the integrative harmonic trading methodology. Basically, we have a move that I label as a 0 to X move, basically just some type of a directional move in a stock, and then we have a what we label as an A, B, C type of correction that that correction ends inside, so it ends within the high and low boundaries of this move. And then we're going to look for specific entry signals based off of this methodology. And again, that's not what this video is about, but I want you to understand here that there are things to look for in order to give you a high quality signal to create a buy or a sell setup. So that's what some of these lines here and these labels are here. Alright, now let's assume that we took a long signal on this trade somewhere in this range, which would be very realistic given the methodology I teach you. Now what I'm going to show you here is something that can be used regardless of your entry signal. You can use any methodology, any form of technical analysis, and then you can use this stop movement strategy to allow you to stay with profitable trends for a extended period of time. And here's the method in its simplicity. Once you have an entry signal, you're going to have an initial stop point, and that should be determined by your trading methodology. In this case, let's just say the stop loss point goes below point C, which is what I teach in my trading course in the integrative harmonic trading methodology. Once that happens, what we're going to do in this case for a stock where we're going long is we're looking for times where price moves and touches the red line, which is the moving average of the lows. Alright, so it's touching the lower border of the moving average channel. And every time it touches the channel, as it did here, and then moves to a new price high for the trend, we're then going to adjust our stop upwards to just below, literally just a penny below the touch of that channel. And you're just going to do that indefinitely and trail the stop. Alright, so let's zoom in a little bit on this chart here. So let's say we entered this stock here, we set our initial stop down here somewhere, we see price rise, and now we see it touch the channel. Okay, we don't move our stop yet. We wait for it to touch the channel and then move to a new price high, which is at this point right here. And as soon as it does that, we don't even have to wait for a closing bar. As soon as it breaks that old price high, we then move our stop to this level. And then we don't move the stop again until we see another touch of the channel, which occurs right here, followed by a move to a new price high, which occurs right here. And at that point, we would immediately move the stop loss to just a penny below the low of this touch of the channel back here. Alright, and we are not going to touch that again until we see another touch of the moving average channel, followed by a break to new price highs, which we see at this level. We would then move the stop to here. We don't see our next touch of the moving average channel till right here. And then once price breaks to a new high at this bar, we're now going to move this stop loss to here. Now we see price move back again and touch this lower channel, and then once we see this breakout to a new price high at this level, we're then going to move the stop down below here. And as of currently, this stock is still long, still active. So what we would be looking for is for this stock to let's zoom out a little bit here, for this stock to either continue higher or consolidate for a bit, touch the channel again as it's moving up and break to a new high, and we'll continue to trail the stop. And what that does is, instead of saying, wow, look, this thing has gone up from $20 to $45, maybe I should get out, well, let's let this trend persist for a long time and let it take it as far as it'll take us, and that might be 100%, maybe it'll be 2, 3, 400%. You never really know. And the point of really the point of a good trading methodology is to keep you in those profitable trends for a very long time, so that the small percentage of trades you make that turn into truly phenomenal gains, that you'll still be in them when they're up 2 and 3 and 4 and 500% or so on. I'm going to go through a number of other examples here relatively quickly. I just wanted to give you a somewhat in-depth view of one explanation of this on one pattern here for you to look at. And then we can just move through some different charts here, and you can get some repetition on these next examples. All right, so the next chart we're going to look at is Century Aluminum, symbol CENX. I'm going to move into a daily chart. This is a stock I showed on my blog for members who are actually taking my course training. We had ABC patterns completing here, and then we had a smaller ABC pattern completing here, and we're just going to go through this and use this trailing stop methodology here. So let's say we got an entry signal on this stock somewhere at this level. All right, and then we see price move up here, and now price comes down and touches this moving average channel. Well, we're not going to move our stop from this initial stop level, wherever we had the stop, until we see price break to a new high, and that doesn't occur until all the way over here. At that point, we would now move this stop to below the lowest intervening point of this correction, so we would now move the stop to just below here. And then we see price move up. Now it touches the channel. Once it breaks to a new high here, we would then move the stop to just below the lowest point of this minor correction that brought it down to the channel. Now we see price move up again, and now here it's come back down and touched the channel, but we do not have price yet moving up to a higher high, though it's getting close. So if we see on this stock on Century Aluminum price break above this 1260 level, we're then going to be able to move our stop down to below this level here. And just the way this pattern is shaping up, I actually, if I was making a discretionary stop placement on this, I would actually place it below this low here, because we did see another moving average channel touch here. So I would actually place it at that level. But either way is going to work. This way will allow you maximum room for this stock to continue. This way will lock in a little bit more profit, but it will increase the odds of that trade being stopped out potentially prematurely when you look at it in retrospect. So that's another example of a type of pattern we trade, and then how to move the stop. We're going to look at symbol UNG, which is a natural gas ETF. So if you're interested in natural gas prices, then you can use this ETF. And so here's the basic pattern. Again, we have a 0 to X type of move as I label them. We have our ABC correction, so we would be looking to be a buyer of this stock roughly in this level. And in this stock, we're looking at a daily chart, and we can see that we don't get a moving average touch on this until all the way up here. And then once we see price break to a new high, we would move the stop to below this low here, at which point that would end up being stopped out on the daily time frame. But one thing I want to show you here is, and I'll talk more about this when we get to a couple other more extreme examples of directionally moving stocks, is you can actually exit only a portion of your trade on a smaller time frame, and then use a longer term time frame to exit a portion of the trade as well. And in this case, using a daily chart, this method would have got you stopped out here. But if we move to a weekly chart, you can do that by simply pressing 5 here on freestockcharts.com. Again, this is the pattern we just looked at here. Now here's the moving average channel for the weekly chart, and we can see that it didn't touch the moving average channel till down here. and then broke to a new price high up here at this level. So the stop loss would currently be at this level around $19.50 on UNG, and we've yet to see another touch of the lower channel. And if we kind of zoom out here and give this chart some space, we can see how it's certainly possible that we see this stock run up, consolidate and touch the lower channel, and then continue a bullish trend, and we could continue to adjust those stops up if this stock does remain in a persistent trend, something to the effect of you saw in this major downtrend here in UNG from 2008 to 2012. So that's a method you can use too, is really looking at a couple time frames, and for using a method like this, that is what I would recommend. Now let's move to a chart of First Solar here, and this is a chart that I've showed both to subscribers of my services and recommended that back here in September, and I've also showed on public videos here on YouTube. But let's zoom into a daily chart here, and so here's our pattern. Here's where we'd look for our entry signal, and then once we have our entry signal, we then start to use this channel method here. So here's a touch of the lower channel, price breaks to a new high, we put our stop here, price moves up, comes back, touches the channel, breaks to a new high, our stop would go here. Same thing here, price moves up, touches the channel, when it breaks to a new high, stop loss goes here. And in this case, using a daily time frame here, that would end up ultimately leading to a stop out down here at this level. Now if you move out to a weekly chart, you can see there has been on that initial run-up of the stock, there was never a touch of this lower channel line until right here, and until we see price break out back to new highs here, which would be at around the $66 level, we would not move the stop from our initial stop point. When it does move to that level, then we would place our stop at the just below the lowest point of whatever intervening correction here happens prior to the break to new highs. So that's an example on First Solar there. Look at a couple more examples, then I'm going to show you some more extreme examples. Let's run through here. This is Dr. Pepper Snapple group. Again, here's our pattern. We look for an entry, and in this case, we can see a touch of the channel, price move to a new high, and then price reverse and would actually come down and lead to a stop out. So in this case, we actually get what in retrospect may be a premature stop out. Maybe this trend has further to go, and that's just the nature of the markets, is they're going to find ways to kind of take you out of trade sometimes, and that's just part of trading. You take your profit or loss and you move on from a situation like that. We look at Riverbed Technologies. This is one I had mentioned to subscribers around an earnings period here last year. So we see our initial move up, we see our corrective move. Let's say we got a buy signal somewhere in this range here. We've not yet seen a touchdown of the moving average channel. So technically, we would want to keep our stop at whatever initial point that it was at, wait for price to actually touch the red line, and then move to a higher high before adjusting the stop. Now, personally, if I entered a stock at these levels here and price was all the way up here, even though this pullback did not touch the moving average channel, I certainly would not be opposed to placing a stop at a minimum just below this point here on a practical level, even though it didn't quite touch the channel. But if you want to be very rigid with the rules, which is oftentimes better, especially if it's a new methodology that you haven't used time and time again, I think you're better off just following it very rigidly. So that's another example there. Let's look at symbol MSTR, which is MicroStrategy. And this was a stock that I showed repeatedly to people taking my course on the member blog there for students. This was a stock that triggered a buy signal right in this level here, around $97, and then we had a smaller pattern form here, triggering a buy signal around $100 on this stock, and we've seen it move up here. And again, this is a weekly chart. And again, you can see here's a touch of the channel, a break to higher highs, another touch of the channel, break to higher highs, another touch of the red lines here, followed by a break to higher highs. So currently in this stock, the stop loss would be at $113.88, just below this low here. Still the potential for this stock to continue a bullish trend. And you think that, well, how long can this stock go? Well, just look at what's happened in the past. Look at these very directional moves in prior phases of this stock, and you can see that they've basically remained at or above the moving average channel for the duration of those major moves. And by the time you saw price really come and stop that methodology out, you were really through the main trading trends in the cycle of that stock price. So very, very effective on a weekly time frame to keep you in major trends that may last a better portion of a year, sometimes even longer than that. And we'll look at a couple of those here. So that's another good example here. And let's look at a couple extreme examples now and talk a little bit more about how to use this on a multiple time frame basis. Let's look first at symbol SPWR, Sun Power Corporation, which is a solar stock, and go into a daily chart here. I first made note of this pattern. If we move back here and we see that this massive bear market from $160 all the way down to $3 in First Solar, where it bottomed in 2012. And coming off that bottom, there was a type of pattern we looked to trade here. And so we got our first potential buy signal for for a relatively small scale pattern down here somewhere in this level. And so this is a daily time frame. And you can see some moving average channel touch points and kind of follow that up and say that, say we bought the stock all the way down here around $4.50 with a stop at $3.90, which is roughly accurate. Let me take you back here and just show you some of the power of this method and follow this through. So even just using a daily chart on a relatively small pattern, let's say we counted this as a touch of the moving average channel, even though it may be a penny or so above there. We see price break to a new high, so our stop is at this level here. Now we come see price touch the channel again, and here it breaks to a new high, so our stop is now below this level here at around 740. And let's scroll a little bit further on the chart. And then we see price move up again, and now we see price come down and touch the channel, but we're not going to move our stop until we see a break to a new price high. Well, off of this high, we saw another very nice pattern setup given the methodology that I teach, and they actually recommended this stock somewhere in this level, right around $11 or so in here, and we then saw price I think closer to $12 on this stock, and then we saw price break to a new high, at which point we could move the stop to below the lowest point of this intervening correction. So we're still long the stock here, based on a signal with around 60 cent initial stop loss. We don't see our next touch of the channel till this level here, up around $19.30. We don't move the stop until price breaks to a new high at this level, and now our stop would be at $17.50. We see our next touch of the channel right here, and then we see a break to a new high at which our stop would go here, and eventually be stopped out a couple of days later around $24.75. So even just looking at this on a daily time frame, we had a 60 cent roughly initial stop loss from our entry pattern here to this stop loss, and just using this one time frame, we went from $4.50 all the way up to $24.75. So we saw around a $20 increase in the stock, over a 400% gain just on this one time frame. So, and you can see, how sloppy and time consuming some of these corrections were, and that's part of the beauty of this method, is that these the channel is adaptable because it moves off of the lows, in this case, of the price movement, and by waiting for a break to new highs, we allow consolidations to take place prior to those next trending moves. And so when you look at stocks, they're going to go through periods of directional movement and periods of corrections or basing patterns. And by waiting for the price break to new highs, we're going to allow these basing periods to happen and then break out. And then we're going to be able to systematically adjust that stop in the next trending period. And if it's in a stock like this where those trending periods are very strong and we never even get a touch of the channel, we may be able to, adjust our stop loss relatively wide through several basing periods and make a huge gain on the stock. Okay, so I think that's a powerful example of the potential this method has. And what I want to show you now is, okay, let's say we actually got in that stock and we know that it was in a huge bear market for the last couple years, and we think this stock could potentially be in for a major bull market. Well, we could then use simply exit half of our position or some predetermined portion of our position using that daily time frame we just looked at, which say took us out here around 24.75, but then we could keep a portion of those shares in hopes of a larger gain, which may be very realistic, and go over to a weekly time frame and now apply the same methodology here. So on a weekly time frame, let's say we got in here again around that 450 level. Well, we didn't see our first moving average channel touch here until the 1050 level. We saw our next touch here in a price break to new highs, so our stop would be adjusted there. Here's our next touch of the channel, price breaks to new highs, so our stop is here. Here's our next touch of the channel. Price breaks to new highs here, so our stop is there. And now we have another touch of the channel here in early February, and price is hovering just under new highs. So assuming this stock pokes up over the next couple of days, we would then still be long the stock with a stop here at $28.11 on SunPower. And so if you got back on that stock on a daily time frame at 450, you now have $24, or excuse me, yeah, even with the stop loss locked in at 28, you now have about $23.50, or 400 to 500%, about 500% gain locked in on that stock, and it's still going. So that's the beauty and the power of using a truly trailing methodology. Is you don't get up 100-200% and say, oh wow, this has gone up a lot pretty fast, I'm going to get out here while the gains are still good. Well, maybe maybe this is going to be that one trade that makes your entire year, or maybe even makes you as a trader, especially if you're dealing with a large account. And you get a stock that moves 1,000% for you. It's not going to happen often, but they happen. You get a stock that moves like that on a significant portion of your account. You just maybe made a year or two income off of that one trade. And then if you are a long-term successful trader, the massive effect that type of a trade can have on the ability to then compound even future just typical trades in your account is dramatic. So having a truly systematic trailing methodology is going to be vital to staying with these large winners. So wanted to show that on more of an extreme example here. I'll show you another extreme example. This is symbol CCIH, China Cash International. So this is a weekly chart again. Stock apparently IPO'd back here 2010. We had this kind of saucer type of bottom here through 2012 and 13, and a big breakout here. So let's say we got in this stock. Let's just say we got in it on the breakout here of this saucer pattern at around 855, which is very realistic. Or maybe we even got into it up here around 1060 on the breakout of this next basing pattern. Well, using this weekly moving average channel, we can see a few touch points of the channel here. The most recent touch point was all the way back here at around would have our stop loss somewhere around $6.50, and the stock's all the way up at 25, $25 here. But who are we to say the stock couldn't continue much higher? The market sometimes can maintain persistent trends. So to really truly allow this thing to go, here's what I'd do. I would look at this on 2 time frames, and let's say we got in it back here at 850 on the breakout of this saucer, or back here at the breakout of this base. And so now you have 100 or 200% gain on the stock, and you're thinking about, I have a lot of gains. I'm not opposed to taking a partial profit, especially since we're maybe nearing the all-time high. Is it going to break through or not? We don't know. So let's go down to a daily time frame and just look at this. Well, okay, so let's look at those price points again. And here's the breakout level at 850 would have been somewhere back around, let's say it would have happened right in here. So let's zoom in a little bit better here. So the initial breakout of that saucer pattern would have occurred somewhere right in here. Well, so let's say we bought it, and our initial stop was somewhere down here below the prior touches of this channel, which would be reasonable. Well, here's our first touch of the channel after the breakout, but we're not going to adjust that stop until price breaks to a new high, which it does here around 1065, at which point our stop would be here. Then the stock runs up all the way to 1725. We have our next touch of the channel here, but we're not going to adjust that stop until it breaks to a new high, which occurs here. So the stop would then be adjusted to about 1255, and we've just had our next touch of the channel right here on a daily time frame, and so our stop loss would be just below this level here, so around $18.80. And so looking back at this, even just on the daily time frame, buying that initial saucer breakout, we still haven't been stopped out on this stock on a daily time frame, and we're up a couple 100% on this stock. So here's what I would suggest is, you continue trailing this stop loss up. Currently it's at $18.80 on the daily time frame. And let's say you just treat this as a 2-unit trade. So half your shares, you're going to place a stop loss in the market, active in the market, at $18.80. And then the other portion, we're going to say, okay, maybe this is a new IPO. This stock really hasn't had time to make major gains. This thing could go to the moon. So how do we let it do that? Okay, so let's move to a weekly chart. So on our weekly chart, let's say we got in at that 850 level or something like that back here on the saucer breakout. 2 options. The systematic option is you keep your stop below the prior weekly moving average channel, around $7. The other option is you simply move your stop to a break-even point based on this trade wherever you entered, and then you allow it to continue to move, form basing periods, touch that channel, and break out to new highs. And this stock may go, another couple 100% higher. So that's a very realistic way on a stock that's moved substantially, a growth type of stock, to treat it in 2 time frames and multiple units. So you exit a portion based off of a lower time frame, but then you use the exact same method to then move the stop on a higher time frame. And so I think that's an excellent example. This can also be applied to stock indexes. So I'm going to move over here to SPY, which is the S&P 500 here. This is a weekly chart, and let's just go back to the October 2011 low and look at this methodology here. There was a major correction. Depending on what type of methodologies you use, certainly some potential for some buy signals somewhere in this range here. And let's say we got in somewhere here with an initial stop down here. Well, using this moving average channel method, our first touch of the channel is here. Breakout to new highs, our stop goes here. Our next touch of the channel is here. We don't move the stop until it breaks to new highs in January 2013, and then our stop loss is down here. We don't have another touch of this channel really until June of 2013. Price breaks to new highs. The stop is now here. Here's our next touch of the channel in August of 2013. Then price breaks to new highs in September. So the stop loss would go here. Let's zoom in a little bit. We do see price pull back close to that, but not stop it out. We touch the channel again, breaks to new highs, and at that point our stop loss could be moved here. If we zoom in on here, you can actually, if you scroll in tight here, it actually doesn't touch the channel here, but let's just say we wanted to, move our stop up. We could move the stop to here once it breaks out, and then that would have resulted in us getting stopped out, here at 177.35. But if we chose to maintain our stop down here because we didn't truly get a touch of the channel here, our next touch of the channel is not till January of this year, at which point we've just recently broken to a new high, and our stop would be below the February low of this year, and still have potential for further gains. So that's looking at a very real scenario here in the S&P 500 of getting in the stock, say roughly between $130 and $120 realistically, and with a stop loss of maybe $10 or so on the trade, and we're now up close to 190, so $50 close to gain currently on a $10 stop loss, and still potential for more. So that's how this method will let you stay with these major trends and trail the stop systematically, allowing for major price gains. So if you're looking at bearish patterns, everything is the exact same. You're gonna look at downtrends, and you're going to use the green line instead of the red line. So when price rallies up to the green line and then breaks to a new low, then you adjust your stop. Obviously, stocks are kind of designed to go up, so you're not going to tend to have the same type of major persistent trends in bear markets as you do in bull markets, but certainly on shorter term time frames, intraday, or even looking at multi week declines, using a daily time frame moving average channel, that methodology is very effective, and it's also very effective for intraday moves as well. And I've used this type of methodology myself for even day trading off of 1 minute charts. I've used that somewhat extensively, and it's effective. So hope this video is helpful. I want to give you some practical information on basically how to be a better trader by allowing yourself to have bigger gains, and having a methodical way to ratchet that stop loss. So it's not a true trailing stop that you place with your broker. You're still going to manually adjust that, but it is a methodology to create for yourself a logical stop adjustment procedure, more so than what you might think of as a traditional trailing stop with a broker. All right, and I hope also seeing some of the some of these type of patterns will give you a little bit of insight into the types of methodologies I teach and the type of directional moves you can see after some of these patterns. You don't have to be right on a whole lot of them to stay in some major trends and really make a nice profit. And the entry techniques and analysis techniques I teach are really good for fine-tuning when to get in that stock with a low risk, and then you use these trailing type of techniques or similar ones to get a major reward and really stay with that stock as long as it'll go. If there are any further questions on this method, please leave a comment on YouTube here, or you can leave a comment over at stockmarketalchemy.blogspot.com. If anybody has any more interest in learning how to use this moving average channel for a trading methodology, or for potential exits, indicator-based exits without just using the trailing method, those are things we could go over as well. But I'll kind of leave that up to some feedback here of whoever's watching these videos. So with that, I will let you go for today. I hope you have a wonderful day and wish you all the best in your trading.